Hey guys, Joel Frank here, market analyst for YouTrading, and today we're going to take a quick look at gold, spot gold prices. Look at the chart here. I've got it on 1 hour, 1 day, one day candlesticks, so we can really see how gold has been doing for more than the last year. And the thing I want to talk about is really the fact that gold has managed to remain very, very well supported in recent days, despite the massive hawkish repricing that we've seen in its expectations for Fed tightening this year. So just to recap, since the hawkish Fed minutes last week sort of revealed that there's very, very strong support on the Fed board for multiple rate hikes this year, as well as quantitative tightening. That's what the Fed minutes revealed. And also that's what we've also had Fed speakers sort of backing that up in recent days as well. We also had the labour market report on Friday, which, yes, the headline number wasn't as good as hoped for, but it showed that the labour market is very, very tight. The unemployment rate was 3.9%. Other measures of slack also improved. Wage growth was really, really strong. So in wake of all of that, there's been this cascade effect, basically, where now you've got all these banks calling for 4 rate hikes in 2022. Money markets now pricing 4 rate hikes in 2022. The March Fed meeting pretty much seen as a certainty for a Fed hike now. So despite all of this, and this has sent US bond yields shooting higher. I mean, let me just have a quick look here. The US 10-year is currently just below 1.8%, which is about, well, I think probably more than 25%, 25 basis points up on the year. And the 10-year real yield, the 10-year tips, is up closer to 35 basis points on the year at about minus 0.75%. Typically, these kinds of moves in US bond yields as a result of hawkish Fed expectations would do a lot more damage to gold. But if we just kind of zoom in, you can see that spot gold topped out at the start of the year, basically, last week around the 1830 area, and it did dip as low as 1780, but it has since recovered back above the 1800 level, and it still continues to stick pretty close to these moving averages here. So that's the 200 in yellow, the 50 in sort of the turquoise, and then the 21-day moving average in the blue. So quite surprising, really. And to be honest, the reason that the gold has been able to hold up is because for now the dollar hasn't seemed to benefit from all this Fed hawkishness. But if the dollar does start to benefit, which many FX strategists think it will, well, then we could start to see gold, the sell-off in gold really get kicking. I mean, obviously the first bearish target you'd want to look at is around 1750 here. But if the dollar index really gets going, well, we could be headed all the way back to 725 or even sub 1700 levels and towards a test of last year's lows, around 1680. What events could be the catalyst for such a move this week? Well, it's Tuesday, and we've got Fed Chair Powell's renomination hearing at the Senate Banking Committee today, where he might basically give some indications about potential timing for all of this Fed tightening, particularly with regards not just to rate hikes, but also with quantitative tightening. We've also then got Lael Brainard. She's the nominee for the vice chair positions. She's testifying on Thursday. And perhaps most importantly, we've got consumer price inflation data in the US out on Wednesday, with analysts expecting the headline to hit 7%, which is like multi-decade highs. I mean, it's already at multi-decade highs, but all of this could sort of shore up these hawkish Fed expectations, could boost the dollar, potentially, be on notice for that. And if that did happen, then things would not be looking good for gold. But anyway, guys, hope you enjoyed the video, and I'll see you all in the next one.